each one of those, the dollar didn't lose reserve status. It just had these big giant fluctuations compared to other currencies. And so a lot of times when the dollar starts to go down, you have all these headlines about dollar reserve status being questioned. The dollars at the action in the system. The United States is one of the countries that's not really doing that. They're not, say, if you look at our foreign exchange reserves, we're not printing dollars to buy foreign assets.
If your economy was producing a lot more than it was importing, your currency would generally strengthen over time, and that would basically, the purchasing power of people in that country would improve, and they would often start importing more, and eventually, that system would kind of balance out. Whereas on the other hand, if your country was not exporting enough to keep up with its imports, eventually the currency would weaken, which would weaken the importing power of people in that country. And basically force them to produce more. There are a few factors, but the main one is related to currency differentials. And so because the entire world needs dollars, there's a lot of persistent demand for dollars. If you look at most countries, if they start to run persistent trade deficits for a while, then the next time they have a recession or some sort of financial event, usually what happens is their currency ends up getting pretty weakened. And what that does is, it's painful when it happens, but when it happens, it makes their export competitiveness stronger, and it reduces their import capability. And so it ends up realigning their trade deficit back towards a more balanced state. And so one thing I do is I separate a dollar bear market from a change in the dollar reserve status. And so, for example, if you look back over the past 50 years, we've had 3 dollar bull cycles, kind of 2.5 dollar bear cycles, depending on where we are in this current one. Each one of those, the dollar didn't lose reserve status. It just had these big giant fluctuations compared to other currencies. And so a lot of times when the dollar starts to go down, you have all these headlines about dollar reserve status being questioned. But the United States, we never go through that process. When we have recessions, often our dollar gets stronger. And so we never are in a position where our currency kind of makes sense relative to our balance of trade. We don't have that corrective mechanism that most other countries have. And that's kind of that's the core issue. Is there something more structurally happening under the surface? And so my view is yes. I mean, basically, the creation of the euro, over 20 years ago now, that has somewhat reduced the dollar's importance, in terms of its share of global reserves. And then now the next round that we're seeing is that Russia is more interested in selling their oil in euros and then de-dollarizing their reserves. They've been investing primarily in gold and euro-based assets for their reserves. Between Russia and China, they've actually de-dollarized their trade quite a bit. And it's partially local currencies, but it's also the euro took a big chunk of their trade between Russia and China. And we've even seen, for example, Russia and India have a little bit de-dollarized some of their trade as well. And so you have that kind of natural balancing mechanism with gold at the center, and then these other currencies kind of moving around each other. Then there's some other factors like just fiscal policy and kind of geopolitical policy. A lot of these other countries have rather mercantilist policies where they try to purposely maximize exports and keep their import power, somewhat tight. So a lot of them will purposely weaken their currencies as much as possible compared to the U.S. dollar. We see this kind of playing out where we see more and more direction of a global, kind of a multipolar currency system, rather than the dollar having such a strong lock on global trade. And so overall, I do think that factors into my longer-term dollar bearish thesis. And I think it's almost inevitable to happen, because one thing I like to point out is that in the beginning of this, the U.S. GDP was like 35% or more of global GDP. And we were by far the biggest commodity importer. And so they had all these deals where, almost all commodities are priced in dollars, regardless of who's buying, who's selling. It's all dollar-based. But when you get to the point over time where, the United States is something like 20% of global GDP, a little bit more, a little bit less, depending on if you're looking at, purchasing power parity or nominal. But, it's gone down in any way you measure it. And then you look at the fact that we're no longer even the biggest commodity importer anymore. We're number 2. And one of the problems we've had, especially since the 1970s petrodollar system that's in place, is that we have this weird incentive for multiple countries to want to purposely devalue their currency compared to others, because they want to keep their exports competitive as possible. Whereas the U.S., we purposely never really built foreign exchange reserves. We don't go through these processes of purposely weakening our currency, unless there are a handful of times we got really bad, like in the Plaza Accord, 1985. Basically, the world's just kind of shifting more and more towards having a handful of currencies that are able to buy commodities rather than just one currency. And so I do think that factors into basically a dollar bear market thesis in an overall more inflationary environment. But basically, if you look at how pricing works in markets, it's often that marginal price that generally comes in and affects the whole thing. And so same thing can happen in commodity markets. And so generally, when you have a dollar bear market, and if you were to have an environment where more currencies can price commodities like say euros or China's currency, that opens up, it basically broadens the types of channels that can go around in terms of how these pricing are set. And so basically what they're trying to do is be able to buy commodities in their own currency so that you don't have a situation where the largest commodity importer is using another country's currency in order to buy all of their commodities. So the current system as structured basically has all these different players purposely trying to devalue their currencies to basically boost their exports. Because the dollars at the axe in the system, the United States is one of the countries that's not really doing that. They're not, say, if you look at our foreign exchange reserves, we are not printing dollars to buy foreign assets. Basically, we're the ones that end up being the ones with the trade deficits because we are we're not intentionally devaluing our currency at the same way, at least with the same mechanism that the others are doing it. When there's this much debt in the system, when there's this many bottlenecks in the system, usually it requires a very big phase change, which is generally, at the core of that is a currency devaluation before things essentially get reset. Because when they build up that much debt, when they use artificially low interest rates, they use all sorts of programs to basically get debt this high to begin with. They never could have gotten this high without some of the manipulations that have occurred. So when they get debt this high, it's almost impossible to unravel it without crashing the economy. And so instead, they turn more towards currency devaluation. And so essentially, until you have probably a significant currency devaluation and kind of a somewhat of a reset of the situation, you're unlikely to untether markets from these big kind of central forces. But if you look at individual segments of the market, there are still areas that are kind of undergoing price discovery a little bit more. And so we've had these kind of gross to value rotations. So I would say that if you look at the market underneath the surface of the index, it kind of made more sense in that, in the sense that where the cyclical things have responded to good economic news more. But I think that for the broad indices to start following good news, it's going to be very tough until we actually get past some of these giant debt problems that we have, and that's not going to be, smooth. And so, the 2020 was the year where the sheer amount of fiscal and monetary stimulus kind of overwhelmed that deflationary force for a period of time. And so it's kind of like each year just kind of seeing how the magnitudes of those two forces compare to each other. And so overall, I agree that most systems have some sort of imbalance to them, especially if there's no kind of central neutral asset, whether it's something like gold or Bitcoin. And then it just becomes a matter of degrees. And so the current one, if it's centered around one country, you're likely to get these really big multi-decade imbalances. Whereas if you have another system that's kind of more decentralized, you have a lot of messy outcomes, but it generally prevents like a really big imbalance forming for decades. But instead you have a lot of these micro imbalances that keep sorting themselves out, but the system itself is just not very effective. If your country was not exporting enough to keep up with its imports, eventually the currency would weaken. And so my view is yes. I mean, basically, the creation of the euro, over 20 years ago now, that has somewhat reduced the dollar's importance, in terms of its share of global reserves. Whereas the U.S., we purposely never really built foreign exchange reserves. Basically, the world's just kind of shifting more and more towards having a handful of currencies that are able to buy commodities rather than just one currency. When there's this much debt in the system, when there's this many bottlenecks in the system, usually it requires a very big phase change, which is generally, at the core of that is a currency devaluation before things essentially get reset.